All right, welcome to another deep dive. This time we're tackling Forex trading.
Forex. Sounds intimidating.
It can seem that way, for sure, but we're going to break it down, and hopefully by the end of this, you'll be ready to at least have an intelligent conversation about it.
All right, I like that. Let's demystify it.
We're using Jim Brown's book, Forex Trading, the basics explained in simple terms, as our roadmap today. So where do we even begin? What is Forex trading?
Well, it's all about currencies, but not just buying and holding them.
Okay, so it's more dynamic than that.
Much more. Think of it as speculating on the value of one currency against another.
So like betting on whether the dollar will be stronger than the euro.
You got it. And that's where those currency pairs come in.
Currency pairs.
Yeah, like the euro against the dollar or the yen against the pound. They're always traded in pairs.
Okay, starting to get the picture. But how big is this market, really?
That's the mind-blowing part. Brown says the daily Forex trading volume averages something like $5.3 trillion.
Trillion. Whoa.
That's like $220 billion changing hands every hour.
That's insane. But wouldn't that mean my little trades get lost in the sea of money?
Actually, that's one of the things Brown points out as an advantage. The market is so vast, your individual trades don't really move the needle.
So less volatility then.
In a sense, yeah. And speaking of volatility, Forex is traded 245. No frantic opening bell or overnight gaps in prices.
Gaps.
Yeah, when a stock price jumps up or down drastically overnight, that doesn't really happen in Forex because it's constantly trading.
Okay, that makes sense.
Mhm.
But is there ever a time when it's not a good idea to be in the market?
Well, Brown tells this story about getting caught out by the capture of Saddam Hussein. It happened over the weekend when the market was closed. The dollar soared when it reopened, and there was nothing he could do about it.
Ouch. So weekends can be a bit risky then.
Yeah, they can be.
Good to know. So we've talked about the scale and the 245 trading. What else makes Forex stand out?
Brown highlights the fact that there are a relatively small number of currency pairs to focus on.
I would thought more options would be better.
Not necessarily. He argues that it actually helps you learn faster. You're not dealing with thousands of stocks. You can really zero in on a few key pairs.
Quality over quantity. Makes sense.
Exactly. And those pairs often show clearer trends than you might see in stock charts.
So easier to spot patterns.
Right. And Brown even says many Forex charts look smooth compared to the ugly volatility of some stock charts.
So Forex has this stability. It's constantly trading. And there's a smaller set of currencies to track. What else makes it attractive?
Well, the costs are generally lower than in other markets.
Oh yeah, cost is always a big factor. What are we talking about here?
You often have minimal or no commissions, and the spreads are usually tight.
Spreads.
The difference between the buy and sell prices? Tight spreads mean lower trading costs.
Makes sense. So we're talking about lower costs, clear trends, continuous trading, and a manageable number of currency pairs. Sounds pretty compelling so far.
And we've only just scratched the surface.
All right, so let's break down those currency pairs a bit more. You mentioned pairs, but what are the main players in this Forex world?
Well, Brown starts with what he calls the majors.
The majors. Sounds serious.
They are the most heavily traded pairs, and all of them involve the US dollar.
Okay, so like the dollar against what?
Well, there's the euro against the dollar, that's URUSD. Then there's the Japanese yen against the dollar, USDJPY. And of course, the British pound against the dollar, that's GBPUSD.
Got it. So are all Forex pairs just against the US dollar then?
No, there are others. Brown calls them second-tier pairs.
Like a second division?
Kinda, yeah. They also trade against the dollar, but involve currencies like the Australian dollar, Canadian dollar, and New Zealand dollar.
I've heard traders use nicknames for those, right?
Yeah. Like the Aussie, the Loonie, and the Kiwi. They even have a funny story about how the Canadian dollar got the nickname Loonie.
Oh, you gotta hear that one. But first, what about pairs that don't involve the US dollar at all?
Those are called crosses.
So like euro against the yen, for example.
Precisely. EURJPY, that's a cross. Brown says they can be good for traders who prefer working with their home currency.
Makes sense. So we've got majors, second tiers, and crosses. What else do we need to know about these pairs?
Well, when you see a quote for a pair, there are two prices, the bid and the ask.
Bid and ask. What's the difference?
The bid is the price you can sell at, and the ask is what you can buy at.
Got it. So which one is the one that matters?
Well, both matter. The difference between them is called the spread, and that's basically your trading cost.
Okay, so understanding the spread is key to figuring out potential profits and losses.
Absolutely. It's a fundamental concept in Forex trading.
Great, so we've laid out the basics of currency pairs, how to read them, what's next. What about actually trading these things?
Well, that's where the mechanics come in. Stuff like how much currency you trade, the role of margin and leverage, and of course, the most important part, managing risk.
Okay, that sounds like a whole other deep dive.
It is. And we'll tackle that in the next part. Stay tuned.
Hmm.
All right, so we're back, ready to dive deeper into the nuts and bolts of Forex trading.
Yeah, let's get into the actual mechanics of making those trades. You mentioned lots before the break. What's that all about?
Right, lots. So you don't buy like individual units of currency in Forex.
Okay, so how does it work?
You trade in these bundles called lots, and there are different sizes to choose from depending on, well, how much you're comfortable trading.
So what kind of sizes are we talking?
The standard lot is the most common. That's 100,000 units of currency.
100,000, that sounds like a lot.
It is, but there are smaller options too, like the mini lot at 10,000 units or even a micro lot at 1,000.
Oh, okay, so there's something for everyone. But if I only have a small account, do I need to start with micro lots?
It's probably a good idea, yeah. You want to match the lot size to your risk tolerance and your account balance.
Right, makes sense. So lots, check. What about this margin thing?
Ah, margin. Think of it like a deposit you put down to open a trade. It's only a fraction of the total trade value.
So kind of like a good faith deposit.
Exactly. And here's where leverage comes into play. Leverage lets you control a much bigger position than your margin would normally allow.
Okay, so leverage is like multiplying my trading power.
In a way, yeah. Let's say you have 100.1 leverage. That means you can control $100,000 with only $1,000 in your account.
Whoa, that's powerful stuff.
Yeah.
But isn't that kind of dangerous too?
It can be, yeah. That's why risk management is absolutely crucial in Forex.
Risk management, we keep coming back to that. What does Jim Brown say about it? These specific tips.
He's a big advocate for using stop-loss orders. Think of it as an automatic safety net for your trades.
So it's like a preset limit for how much I'm willing to lose.
Yeah, you got it. The stop-loss order automatically exits the trade if the price hits that predetermined level.
Keeps you from losing your shirt on.
Exactly. Helps you stay disciplined and, not make emotional decisions when things get hairy.
Speaking of hairy situations, Brown talks about that Swiss franc depegging event back in 2015. What happened there?
Oh, yeah, that was a wild one. The Swiss National Bank suddenly decided to unpeg their currency from the euro.
And what did that do to the market?
Total chaos. Huge price swings. Some traders got completely wiped out.
Yikes. So it just goes to show you got to be prepared for the unexpected.
You really do. And choosing the right broker and using stop losses becomes even more important in those situations.
So that Swiss franc event, that was kind of a wake-up call for a lot of people.
Oh, for sure. Risk management is no joke in Forex.
All right, so we've covered lots, margin, leverage, stop losses. What else drives the market? News, right?
You bet. Brown breaks down news into two types: scheduled releases and those unexpected events.
Scheduled releases at stuff like economic reports, interest rate announcements.
Yeah, things that are on the calendar so you can anticipate them and maybe adjust your strategy.
And the unexpected stuff. Those are the real market movers, huh?
They can be. Think geopolitical tensions, natural disasters, the things you can't really plan for.
So how do you keep up with all that news? Seems like it'd be overwhelming.
Brown actually recommends a great free resource: the Forex Factory Calendar.
Never heard of that.
It's basically a calendar of all the major economic releases and events that could affect the currencies.
Sounds pretty handy.
It is. You can even filter the news by currency, impact level, and set up alerts.
Wow, okay, so I got to check that out. So news is a big factor, but what about the relationship between the different currency pairs?
Ah, you're talking about correlation. That's how pairs tend to move in relation to each other.
So some move together and some move opposite.
Exactly. Like the Euro USD and the USD CHF, they often have an inverse correlation. When one goes up, the other usually goes down.
Okay, I see. So if I was trading both of those pairs at the same time, I didn't factor that in, right?
Absolutely. Trading correlated pairs can either magnify your gains or your losses.
Gotcha. It's all connected. So let's say I've been trading for a while, my account's growing. Should I adjust how much I'm trading?
That's a good question. Brown recommends adjusting your position size as your account fluctuates.
So not just sticking to the same lot size all the time.
Right. He personally likes to adjust things weekly.
So like at the start of each week, he figures out his position size based on his account balance and risk tolerance.
Pretty much, and then sticks to it for that week.
That makes sense. Allows for some flexibility as your situation changes. All right, so we've talked a lot about market mechanics, but how do traders actually decide what to trade? How do they analyze the market?
Well, there are two main schools of thought: fundamental analysis and technical analysis.
Welcome back. We're wrapping up our Forex deep dive, and honestly, my head's spinning a little bit.
It's a lot to take in, for sure. But hey, you're holding your own.
Well, with your help, of course. But before we completely move on from that psychology aspect, I gotta ask, how do you actually manage those emotions? Fear, greed, revenge trading, it all sounds pretty intense.
It is. And Brown doesn't sugarcoat it. He suggests a couple of things, like keeping a trading journal, not just for your trades, but also for your emotional state at the time.
So you can see if there's a pattern, like if you tend to make bad decisions when you're feeling a certain way.
Exactly. And he also talks about practicing mindfulness, being present, focusing on the process, not getting caught up in the emotional roller coaster.
Mindfulness for trading. Gotta admit, that's not something I'd considered before.
It's all about building that mental resilience, right? Just like you train your body, you got to train your mind for trading.
Makes sense. And I guess that's where experience comes in. The more you trade, the better you get at handling the ups and downs.
Absolutely. It's a journey, not a destination, as they say.
Okay, so big picture. We've talked about the sheer size of the Forex market, how it works 245, the different currency pairs, and how to read those quotes.
We've also gotten into the nitty-gritty of lots, leverage, margin, those stop-loss orders for managing risk, and of course, how news and correlation between pairs can shake things up.
And let's not forget that whole psychological element, understanding that our emotions can play tricks on us, especially when money is involved.
Right. Recognizing those emotional patterns and developing strategies to deal with them, that's key.
So what's the main takeaway here? What do we want our listeners to walk away with?
I think the biggest thing is that Forex is accessible, but it's not a get-rich-quick scheme. It takes time, effort, and a willingness to learn.
And a strong mind.
Definitely. But the rewards can be worth it if you're willing to put in the work.
All right, so we've given our listeners a taste of what Forex is all about. Where do they go from here?
Well, Brown recommends diving deeper into specific areas that interest them. Maybe it's technical analysis, maybe it's risk management, or maybe it's that whole psychology piece.
Right, find what resonates with you and explore it.
And remember, the best way to learn is by doing. Open a demo account, start practicing, experiment with different strategies, see what works for you.
Brown emphasizes the importance of setting realistic goals, right? He talks about aiming for consistent gains, even if they're small.
Yeah, he uses the example of 20 pips per day.
20 pips?
Yeah, it's a unit of measurement in Forex, basically a small, consistent profit.
Gotcha. So here's a question for our listeners to ponder. If you could consistently make 20 pips per day, how would that change your approach to trading? How would it impact your goals, your life? Food for thought.
Excellent question. And on that note, I think it's time to wrap up this deep dive.
Thanks for guiding us through the wild world of Forex trading. It's been an enlightening journey.
My pleasure.
And to everyone listening, happy trading.